Hey guys, how are you? Thank you and welcome for joining us at AskTheRealEstateInstructor.com. Now today's review is going to be a math review and it's actually regarding financing. So let's go over this. It says a house was listed for $249,000 and the Smiths offered $225,000, which the sellers countered with $235,000. Now this is normal process in every real estate transaction. People go back and forth, right? Now the Smiths, the buyers, they accepted the counteroffer. They said, hey, okay, let's go. So in their financing, they're going to put a down payment of 20% and financing the rest for 525, so 5.25% for 30 years. How much will their monthly principal and interest payment be? All right, so let's go over this real quick. You have answer A, $1,039.64. Answer B is $1,106.99. Answer C is $1,244.50. And answer D is $1,299.50. Let's see how this goes. All right, awesome. So let's go over the question real quick. It says the house was listed for $249,999. Now this is the listing price. The Smiths offered $225,000. And this is offer. Okay. And the sellers decided $235,000 is the right number for me. Is it okay for you? So $235,000 was what we call a counter. Now, the Smiths accepted the counter offer, so they have a meeting of the minds, they agree, right? And they're making a down payment of 20%. Okay, and they're financing the rest at 5.25%. So that's interest rate for 30 years. And this is the term. All right, so this is the whole question. Now what we have to figure out is how much will the principal and interest be on a monthly basis. Okay, so to figure this out, we need to get something called an amortization chart. Okay, so the amortization chart looks like this. You're going to have this in the state exam, so you don't have to try to figure out how do I do amortization calculations. This is a complex calculation that it's going to take years to figure out. You cannot bring to the real estate exam, you cannot bring a mortgage calculator or a scientific calculator. You cannot bring your cell phone, so you're going to have to figure out how to use this chart. All right, so let's go over to the question and break it down. Ready? Cool. So I usually like to ask questions as I go, and I hope this works for you as well. My first question is, do we do any calculations based on listing price? Like, are we going to get the financing based on the listing price or based on the purchase price? Right, so not the listing price. So here's what I do. After I put all the information in, because that's the way I do, I break down the questions and I splatter on the paper, in this case on the screen, and figure out what I need, what I don't need, what should I think of that I might need or not, right? So in this case, listing price, not needed at all. Cool. The next number we have is the offer. Now the Smiths, the buyers, they decided to offer $225,000. But was it accepted? No. That offer was rejected because the sellers made a counter. Now the counter was accepted by the buyer. So that's the number we're going to need. Offer, out. Counter offer, in. So $235,000 was the purchase price that was accepted. Good. It says they put a 20% down payment and finance the rest at 5.25 interest rate for 30 years. If you're trying to figure out what the principal interest is, that's on the financing side. So if I put 20% down payment, that reduces the amount of loan that I need. And what we need to figure out is the loan amount. So here's what we need to look at. If I put 20%, how much was left? So this equals, oh, don't ask me how that happened. So this equals, okay. So this equals, like I was saying, 80. So this equals 80% LTV. Now, LTV is loan to value. The value is 100%. If you put 20%, 80% is the loan to the value of the house. Good? So how do we figure out what LTV is? What is the number? Because for us to calculate the rest, that's the number we need. Here's what I use. I usually teach something in my classes called steering wheel. And the steering wheel is very simple. It's just literally a circle. In that circle, we're going to cut in half and then cut right there. Now, if you look at it, put your both hands on top, and that's the open space you have on your steering wheel, and then you have two small openings in the bottom. Cool? Awesome. So in the steering wheel, this is what we usually have. On top, we have a part or a portion. Part or portion. That's what goes on top, always. In the bottom left, we have rate. Sorry. We have interest. And we have percentages. These are the numbers that go at the bottom left. In the bottom right, we usually have, sorry guys. We usually have base, value, or whole. So base, value, or whole. That's what we have at the bottom. All right, cool so far? Here's what we're gonna do. If there's anything you don't understand, by the way, if there's anything you don't understand as I go through this, all right, take a note, just send me a message. Take a note, send me a message, and I'll explain it again to you. I got no problem in making another video just to make sure you understand. Awesome. So here's what we got. The numbers we have is 80% because that's what we're trying to figure out. 80%. Or, if you've been to my class, 0.80. The other number we have is the value, which is 235. And what we're trying to figure out is the part or portion that's going to be left for us to calculate the principal and interest, right? So because the numbers are at the bottom of this steering wheel, right? Let me show you this cool trick real quick. If the numbers are at the bottom, we multiply. If the numbers are on top, we divide. But the numbers are at the bottom, and because they're at the bottom, we multiply, okay? So when you multiply $235,000 times 80% or 0.80, then the answer becomes 188. And this is the loan. Okay, so this is your loan amount. Now, how do we calculate principal and interest? Is with the loan amount. That's the first thing we do. Okay, so now that we got that out of the way, we need to do something very important, which is we got 25%, that's your interest, and we have 30 years. 525, 30 years. We're going to go into this amortization table, and you're going to see we pick on the rate first, and if we scroll down to 525 and we go to the right to 30 years, there's a number here, and this number is 5.53. Now this is the number we need to amortize, so it's the amortization Okay, rate. So there's interest rates, there's amortization rate. And what does amortization mean? To pay off the loan, how much you need to contribute. So it's not 5.25%, it's actually a little bit more, 5.53 over the 30 years. So this amortization table, I want you to understand clearly. It's per $1,000. So for every $1,000, we have this number. So if the loan is $188,000, we need to divide it by 1,000 because it's per every 1,000, right? So this number is per 1,000, so you know. Sorry. So divided by 1,000, we have 188. Okay? 188 is the number. The last thing we're going to do. The last thing we're going to do is now apply the 188 times the amortization rate that we found. If you put that on your calculators, okay? Let me do it real quick. And if you put that on your calculators, let's see. So 188 times 5.53 tells us that the result or the answer is 1,039.64. In this case, the answer is A. All right. So, oh, by the way, principal interest. I just want to make clear again that this number is only for principal interest, taxes, insurance is not included. So you would have to add that if you're trying to help somebody figure out how much they're going to pay. So on a loan of $188,000 at 5.25% for over 30 years, their monthly principal and interest only is going to be $1,039.64. I hope this helped.